Hello, everyone. I'm pleased to welcome you to this webcast. Our previous webcasts each dealt with a specific section of the IFRS for SMEs Accounting Standard. This webcast covers amendments relating to topics addressed in several other sections of the standard. In particular, we will discuss amendments on lack of exchangeability, preparation of financial statements, employee benefits, share-based payment, liabilities and equity, and a couple of other amendments. Let's start with the amendment to Section 30, Foreign Currency Translation, related to assessing whether a currency lacks exchangeability. An SME might need foreign currency for its operations. For example, if it has a subsidiary or a supplier located overseas. If the SME is unable to obtain sufficient amount of a foreign currency for a specified purpose, for example, to realize or settle individual foreign currency transactions, assets, or liabilities, it has to assess whether that foreign currency lacks exchangeability. An SME assesses that the currency is exchangeable into another currency when it can obtain the other currency within a time frame that allows for a normal administrative delay. It must be able to do so through a market or exchange mechanism in which an exchange transaction creates enforceable rights and obligations. So if an SME can obtain no more than an insignificant amount of the other currency at the measurement date for the specified purpose, the currency is not exchangeable into the other currency. In such a case, the SME must estimate the spot exchange rate by using either an observable exchange rate without adjustment, for example, a spot exchange rate for a purpose other than for which the SME has assessed exchangeability, or another estimation technique. An SME using another estimation technique may use any observable exchange rate and adjust that rate as necessary. The next three sets of amendments we will cover relate to the preparation of financial statements. First, the definitions of material and accounting estimates were updated, bringing them closer to the definitions in full IFRS accounting standards. Information is material if omitting, misstating, or obscuring it would reasonably be expected to influence decisions of primary users of general purpose financial statements. Accounting estimates are defined as monetary amounts in financial statements that are subject to measurement uncertainty. These amendments will help SMEs make better materiality judgments and clarify what an accounting estimate is without substantively changing existing requirements. Second, requirements relating to the aggregation and disaggregation of information in financial statements were amended. In particular, the amendments clarify how an SME aggregates information in financial statements and require the disaggregation of line items in the statement of financial position when such presentation is relevant. And third, an amendment to provide examples of judgments that have the most significant effect on the amounts recognized in the financial statements. These examples are in Section 8, Notes to the Financial Statements. For example, judgments on classes of assets and liabilities for which disclosure on fair value measurements is made. Please note that the examples are not an exhaustive list of the judgments an SME is required to disclose. Depending on facts and circumstances, an SME might have to disclose judgments not listed in the examples. Let's move on to discuss two amendments related to employee benefits. The first is an amendment related to the measurement simplification for defined benefit obligations in paragraph 28.19. Feedback showed that the application of this simplification was inconsistent. To address this, the ISB clarified how to apply the simplification, which should reduce diversity in practice and result in consistent information for users of SMEs' financial statements. The ISB clarified that an SME using the simplification measures the defined benefit obligation at the current termination amount, assuming all the entity's employees terminate their employment at the reporting date. That obligation is not discounted. The second amendment requires SMEs to provide more detailed information than before about reconciliation for defined benefit obligations and plan assets. Disclosure of these additional reconciling items will help users of financial statements better understand the movements between the opening and closing balances of an SME's retirement benefit liability or asset. It also provides more information about SME's cash flows. Let's shift focus and examine three amendments to Section 26, Share-Based Payment. The first set of amendments specifies which transactions are included or excluded from the scope of Section 26 when businesses or entities combine or form a jointly controlled entity, or modify their share-based payment arrangements because of a business combination or other equity restructuring. For example, shares held by employees might be replaced when control of a subsidiary is transferred from one group entity to another during a group restructuring. The next set of amendments clarifies the definition of fair value used in Section 26. The section uses the term fair value differently from how it is used in other sections of the standard. When applying Section 26, an entity applies a different definition and measurement of fair value from the one set out in Section 12, fair value measurement. For the purposes of Section 26, fair value is the amount for which an asset could be exchanged, a liability settled, or an equity instrument granted could be exchanged between knowledgeable willing parties in an arm's length transaction. The last amendment I will cover in Section 26 clarifies the definition of vesting condition. The IASB defined a performance condition and a service condition separately. A performance condition is a vesting condition that requires both the counterparty to complete a specified period of service and a specified performance target or targets to be met while the counterparty is rendering the service required. On the other hand, a service condition requires only the completion of a specified period of service. Let's now discuss two amendments to Section 22, Liabilities and Equity. The first amendment concerns the relief from offsetting amounts unpaid for equity instruments issued by the SME against its own equity. The ISB retained the requirement that if an equity instrument is issued before an SME receives payment, the SME has to present the amount receivable as an offset to equity, not as an asset. However, the ISB introduced a relief permitting the SME to comply with local regulations if they are in conflict with the requirement in the standard. For example, if they require the receivable to be presented as an asset. The second set of amendments results from updates made to other sections of the standard. The amendments relate to the removal of contingent consideration in a business combination from the scope exclusions in Section 22 as a consequence of the amendments made to Section 19, Business Combinations and Goodwill, and the relocation of the requirements on transactions in shares of a consolidated subsidiary from Section 22 to Section 9, Consolidated and Separate Financial Statements. Just a reminder, there are updated educational modules on Section 9 and Section 19. There are also webcasts on these sections. Now let's move to the last set of amendments we will cover in this webcast. We will examine 8 amendments. The first relates to the initial recognition of bearer plants discussed in Section 34, Specialized Activities. At initial recognition, bearer plants that can be measured separately from produce without undue cost or effort, initially and on an ongoing basis, shall be accounted for as property, plant, and equipment, instead of as biological assets. For example, if an SME that grows cacao to sell to chocolate factories can measure the cacao trees separately from the cacao pods, growing on them without undue cost and effort, the trees will be treated as property, plant, and equipment and not as biological assets. The second amendment relates to financial guarantee contracts, discussed in Section 21, Provisions and Contingencies. You might recall that we discussed this topic in the webcast on Section 11, Financial Instruments. An SME uses Section 21 to recognize and measure financial guarantee contracts if they are issued for nil consideration and when the specified debtor is another entity within the group. Section 21 requires an SME to disclose the nature and purpose of such contracts, uncertainties about the timing or amount of any outflow of resources, and the SME's maximum exposure should the guarantees be called on. The third amendment relates to the offsetting requirements in Section 29 income tax. An SME shall offset current tax assets and current tax liabilities if and only if it has a legal enforceable right to set off the amounts and the entity intends either to settle on a net basis or to realize the asset and settle the liability simultaneously. A similar requirement applies to deferred tax assets and deferred tax liabilities. The fourth set comprises amendments to Section 33 related party disclosures. In particular, the standard now requires the disclosure of amounts incurred for key management personnel services provided by a separate management entity. And the ISB has also clarified the requirement to disclose information about commitments between an SME and its related parties. Moving on to our next four amendments. The Fifth Amendment clarifies the definition of public accountability, a key criterion for eligibility to apply the standard. The ISB made this amendment to present the categories of entities listed in the definition, like banks, credit unions, and insurance companies, as examples of entities that often meet the criterion for public accountability. It is important to note that this was a clarification to help with application. It wasn't intended to relax the criterion. Sixth is the amendment to Section 17, Property, Plant, and Equipment, to clarify that it is not appropriate to use a depreciation method based on revenue generated by an activity that includes the use of an asset, as it doesn't necessarily represent how the asset itself is being consumed. Let's discuss the Seventh Amendment, which affects Section 18, Intangible Assets Other Than Goodwill, and Section 21, Provisions and Contingencies, as a result of the revisions to Section 2, Concepts and Pervasive Principles. You might recall that Section 2 amended the definitions of asset and liability. The definitions no longer refer to an expectation to generate future economic benefits. Instead, an asset is defined by its ability to produce economic benefits, or for a liability, to require the transfer of an economic resource. However, to keep things practical and aligned with the approach taken in full IFRS accounting standards, Sections 18 and 21 will still retain that expectation language. This ensures that the recognition of intangible assets and provisions remain consistent with the previous requirements. Finally, the eighth set comprises amendments made to Section 35, Transition to the IFRS for SMEs Accounting Standard, as a result of the new Section 23, Revenue from Contracts with Customers. These amendments introduce additional exception to the requirement for retrospective application of the standard for contracts with customers completed before the date of transition. So an SME doesn't have to apply the new requirements retrospectively to them. The amendments also added an option permitting first-time adopters to apply Section 23 retrospectively or prospectively in accordance with the transition requirements in Section 23. Now that we've discussed the amendments, let's look at the resources available to support an SME's transition to the third edition of the standard. The ISB published a project summary and a feedback statement, which includes an effects analysis alongside the third edition of the standard. It has also published a version of the standard showing changes since the second edition. The ISB technical staff are also updating the educational modules on the standard, prioritizing sections with significant changes. These modules provide support to anyone learning about or applying the standard. Please note that modules for other sections of the standard will soon be available on the IFRS Foundation's website. Quarterly newsletters and a podcast series dedicated to the standard are also available. The newsletter summarizes news, events, and other information related to the standard. The podcasts offer bite-sized insights to support implementation. Finally, you can submit implementation questions about the standard at any time. You will find the link to submit questions on the supporting implementation page on the IFRS Foundation's website. And with that, we have reached the end of this webcast. Until the next webcast, thank you very much for watching and listening.